And what do we have here? You know, the pension stuff, boy, old Snippies. I know me a thing or two about these pensions and the problems that they have. I've done one too many videos. And not to be outdone by myself, it's time for another one. Authored by Mark Glennon via wirepoints.com, posted on Zero Hedge. A March 2009 Bloomberg article told the story beautifully. The Chicago Transit Authority retirement plan had a $1.5 billion hole in its stash of assets in 2007. At the height of a 4-year bull market, it didn't have enough cash on hand to pay its retirees through 2013, meaning it was underfunded to the tune of about, well, 62%. Then the authority found an answer. We, quote, we identified the problem and a solution, said CTA Chairman Carol Brown on April 16, 2007. The agency decided to raise money from a bond sale. Carol Brown is now Chicago's chief financial officer and leading the charge for the city to issue a similar pension obligation bond for a whopping $10 billion. The concept is simple. Borrow money and invest it in the stock market. The CTA bonds were sold in $1.1 billion. Whoa, why is it skipping around on me? Zero Hedge, what's up with that? Whoa. The CTA bonds were sold and $1.1 billion was deposited into the CTA pension on August 6, 2008. Yes, August 2008. Good times, remember? S&P 500 proceeded to drop 45% over the next 8 months. Mercifully, because the market had already destabilized when the bonds were sold, the CTA did not initially put the money in the stock market, nor did the bond sale go as planned. The CTA ended up paying bondholders more than expected, 6.8%. In other words, the whole plan went wrong and losses ensued, as Bloomberg explained in that 2009 article, which said the proceeds of the bond sale held in a money market fund earned 2%, 70% less than what the fund was paying for the loan. There is negative arbitrage, Brown says. It's better than having dumped the money into the equity market. The stock market did come roaring back after March 09, the beginning of a bull market that roughly quadrupled stock prices. Whether the CTA was able to capture those returns and salvage the pension bond proceeds isn't entirely clear, but it appears that didn't happen. The proceeds of the bond were commingled with other assets. The pension, presumably, got back into the market slowly after being in cash, and many other factors have been at work. But we know for sure that neither the pension bond nor the stock market run stabilized the pension. It deteriorated badly after receiving the bond proceeds through the bull market. At the end of 08, after it received the bond proceeds, the pension had an underfunded liability of $636 million and was 76% funded. Today, that unfunded liability is $1.6 billion and it's only 53% funded. So the real lesson isn't really about market timing, though CTA's was clearly awful. Instead, it's that you just don't know how pension obligation bonds will turn out. In CTA's case, Mr. Market obliterated both its hopes on the stock market and its interest costs on the bond. Nothing worked out as expected. Smaller market disruptions can do the same thing on a smaller scale. Most importantly, the CTA experience tells us how dishonest it is to be making the case for pension obligation bonds through a simple comparison of expected bond rates to hoped for stock market returns. Brown has been making the case for Chicago's proposed bonds quite brazenly. Quote, we should do this because we can do it at 5.5%. Then I just saved the city 2%. I would change the unfunded liability and change how much more in future payments the city would have to make. We would be paying that debt at a rate of 5 or 6% versus 7.5%, she says. Ralph Martire of the Public Union-supported Center for Tax and Budget Accountability made the same deceitful case, pretending it's a simple matter of comparing the interest rate on one credit card to another. The truth probably, and they put a link to that, by the way, in case you want to read that one, The truth probably is that the city's real motivation for a pension obligation isn't to get the 2% Brown claims. That would come to just $200 million a year, which would be nice, but wouldn't really move the needle much on the pensions or on Chicago's $8 billion budget. Instead, the bonds would be a huge gift from taxpayers to public unions, and Chicago is in the middle of a major round of new contract obligation or negotiations with its unions. More about Chicago's likely real motivations are in a separate story linked here. So again, I'll post the link as I do. There's never going to be a solution for these pensions unless they invest in cryptos. That's my opinion. Do you think anybody who controls a pension fund, A, is even going to be allowed to do such a thing, or B, even if they were allowed, would actually do that? That's a massive risky thing. There's never been such a thing before. And, let's go back to the way we've always done things. Yeah. How's that working out for you? 53% underfunded, 70% underfunded, But that ain't going to happen. Ain't going to happen. So sorry about their luck. Sorry about your pension. Again, you get a letter, you get a notice. Pro tip from Jason for we'd like to offer you a settlement buyout pension, 50% haircut. Take the whole thing now or leave it. You take it. If it were me, I would go right into cryptos. 50% loss? Okay, that's fine. That's okay. I'm not upset. You're giving it to me all right now? Yeah, okay. Boom. Crypto market. Hell, again, if this just happened when the market hit the low here recently, it's already up 20, almost 25%. Whole crypto market. There's half of what you needed to go back to. You got a 50% haircut. You just made 25% on that. You got a little ways to go. But anyways, pensions. Boy, oh boy, my God, that I don't have to worry about that. I've never relied on that. Never expected it. I want to handle everything myself and not have a promise or a hope from somebody else that can and most likely will be taken away at some point. See the shirt I'm wearing? Be your own bank. Be your own bank. BYOB. Bring your own bombs, like from a System of a Down? No. Be your own bank. Take care.